Hello, everybody. Welcome to Inventory Part 15. This is LIFO, last in, first out, periodic inventory costing. So LIFO periodic, last goods in are the first ones expense to cost of goods sold. Under the periodic method, we're going to ignore the dates of sale, and we're going to assume all sales happen at the very end of the accounting period. LIFO periodic is a separate costing method than LIFO perpetual. And when we get to LIFO perpetual, you will understand why. We're going to have to compute each separately. So let's get to it. So one of the things I like to ask my students is to always say, under LIFO periodic or LIFO perpetual, what's our goods available for sale? Always going to be the same amount, or in this case, it's $249 for this particular problem. How many units are available for sale? 16,500 units sold, 6,500 units in ending inventory, 10,000. It's the same for every single one. So over here, how many units are we selling? We're selling 6,500 units. So for LIFO periodic, what I'm going to need to do is I'm going to need to take 6,500 units to cost of goods sold. Okay, so LIFO periodic, 6,500 units to cost of goods sold. Now, last in, first out, periodic. Ignore the individual sale dates and assume all units were sold at the very end of the accounting period. Okay, so right over here, I'm going to essentially assume that all sales were made at the very end of the month. Now, I need to take 6,500 units to cost of goods sold. Remember, periodic, I'm going to ignore the individual sale dates. I'm going to assume all 6,500 units were sold at the end of the accounting period. So where do I go? Well, right over here, I've got 8,000 here. So I'm going to take what I need, right? I don't want to get greedy. So this is 228.23. My units are going to be 6,500. My cost per unit is going to be at 18. So this is going to give me total cost of goods sold under LIFO periodic of 117,000. As we saw in the previous video, once I know my cost of goods sold and based on the relationships here, what I can then do is say, oh, my goods available for sale was 249,000. I subtract from those goods available for sale less my cost of goods sold of 117,000. So my ending inventory will be equal to 132,000. So my cost of goods sold is 117. My ending inventory is 132. This has to equal to goods available for sale. Once I've gone through and I've done this particular method over here, is there a way I can check my work? And the answer is absolutely yes. Once I take out 6,500 units from this purchase here, I am left with 1,500 units, right? So if I'm left here with 1,500 units, all of this here constitutes my ending inventory. My ending inventory is 10,000 units. If I add up my beginning plus all my purchases plus what is left from my February 28th purchase, I get 10,000 units. What's the cost of these 10,000 units? 30, 24, 21, 30, and 27 is going to be 132,000. Oh, this is the same number that's right over here. Isn't that exciting? Right now, this is the way we go through and we check our work. This is why computing these constants are so important, because for every part of these inventory costing questions, they're going to be the same each and every single time. So that is LIFO periodic. Again, we're ignoring the dates of sale, assuming all sales happen at the very end of the period. I go last in, first out, last in, first expense to cost of goods sold. So in any event, I want to thank you for joining me here today. If you have any questions below, please feel free to ask them, and appreciate your liking and subscribing. I look forward to seeing you on the next video. Have a great day.